Here's a number that should scare you. 1 in 4 of today's 20-year-olds will be forced out of work for a full year or more because of a disability before they ever reach retirement age. 1 in 4, not 1 in 100. These aren't "it won't happen to me" odds. These are the Social Security Administration's own numbers. And the backup plan everyone counts on, Social Security Disability. It denies about 7 out of 10 people who apply. And if you somehow win, it pays about $1,630 a month. That's it. That's the whole prize. So let's talk about the insurance nobody wants to think about and the $500,000 mistake hiding inside it. Quick question. What's your biggest asset? Most people say their house. Some say their 401k. But the most important asset you've got is your future income. If you're 35, making $100,000 a year, you've got about $3 million in paychecks coming before 65. You insure your $30,000 car, you insure your house. You probably insure your phone, but the machine that pays for all of it, your ability to work, that has nothing. 51 million working adults have zero disability coverage, nothing but Social Security. That's more than half of non-retired households. And here's the part that gets me. People think disability means a freak accident, a construction worker falling off a ladder. The truth, less than 1% of workers miss work from an on-the-job injury. The real killers, back problems, cancer, heart disease, depression. Boring, everyday stuff that hits normal people at desks. It's not if something crazy happens. It's when your body does what bodies do. Okay, so what is disability insurance? Simple version. It replaces part of your paycheck if you get too sick or hurt to work. Usually about 60% of your gross income. But here's where they get you, the details. 3 of them matter way more than the rest. Number 1, own occupation versus any occupation. This is the single biggest landmine in the whole policy. Own occupation means you get paid if you can't do your job. Any occupation means you get nothing if you can do any job, and I mean any job. Here's the example. The industry uses: a surgeon injures her hand. She can't operate anymore. Under own occupation, full benefits. Even if she takes a teaching job under any occupation, they say you can still answer phones. Claim denied, same injury, same person. One word decides whether she gets paid, and here's what nobody tells you. Lots of policies stay own occupation for 2 years. Then they quietly flip to any occupation. Read that section twice. Number 2, the elimination period. That's the wait between getting disabled and getting your first check, usually 90 days. Think of it as a deductible, but in time instead of money. Longer wait means cheaper premium. This is exactly what your emergency fund is for. You cover the first 90 days. The policy covers the catastrophe. Number 3, how the premiums are taxed. If your employer pays for the policy, your benefits get taxed when you claim them. Same if you pay with pre-tax dollars. That 60% just became more like 45%. But buy your own policy with after-tax dollars, benefits come tax-free. That 60% actually feels like your normal paycheck. Now the safety net question. What about Social Security Disability? SSDI. I ran the numbers. They're brutal. Over the last decade, only 30% of applicants got approved. About 20% at the first stage. It takes 3 to 5 months just to get that first no. And if you appeal, right now, over 340,000 people are stuck waiting for a hearing average. Wait almost 9 months. And while you wait, no income is coming in. And the prize for surviving that obstacle course, about $1,630 a month. That's $19,560 a year. Below the poverty line for a family of 2, SSDI is not a plan. It's a lottery ticket with a 2-year processing time. One more thing before the real numbers. Short-term versus long-term. Short-term disability covers weeks to a few months. Think pregnancy recovery, a surgery with a known timeline. About 5% of workers use it each year. Nice to have, but it's not what ruins people. Long-term disability is the catastrophe product. It pays for years, sometimes all the way to 65, for when I'll be back in a month turns into I might never do this job again. Now, a quick myth bust. I hear this one all the time. I'm young and healthy. I'll get it later. 2 problems. First, premiums are cheapest when you're young and healthy. Every birthday, every diagnosis makes it more expensive or flat out uninsurable. Second, the risk isn't old age. 3 out of 4 Americans live paycheck to paycheck. One study matched cancer records to bankruptcy filings. Cancer patients were 71% more likely to crash financially. Young, healthy, and broke is exactly who can't afford to skip this. Okay, enough theory. Let me show you real numbers. Meet Mike and Dave, both 40, both making $100,000 a year, both get the same bad back at 42. Can't work anymore. This isn't a freak scenario. Bad backs are one of the top reasons people file disability claims. Dave's plan was, I'll deal with it if it happens. His employer had a basic group plan, but he never checked it. Turns out it only covered short term. 6 months at 60% taxable. After that, he applies for SSDI, gets denied, and appeals. The whole thing drags past a year. The average long-term claim lasts just over 31 months, so run Dave's math. 31 months with no paycheck at his salary. That's $260,000 gone, and plenty of claims run longer. A 5-year disability at his salary, that's the $500,000 from the title. $500,000 of income. Gone right when his medical bills are piling up. Remember that bankruptcy stat? 78% of bankruptcy filers said losing income helped sink them. 44% blamed medical problems that kept them from working. Dave is on that road. Mike took a different one. Same guy, same salary, same diagnosis. The difference at 35, Mike bought his own long-term disability policy, own occupation. 90-day wait, coverage to age 65. Cost him about 2% of his salary, call it $2,000 a year. About $165 a month. His emergency fund covers the 90-day wait. Then his policy kicks in, $5,000 a month, tax-free, because he paid with after-tax dollars. That's 60% of his income. For as long as he needs it to age 65, same injury, same body. Dave loses $250,000 and fights the government for scraps. Mike collects $60,000 a year, tax-free. Mike's total cost for 7 years of protection, about $14,000. Dave's cost for skipping it, $260,000, maybe $500,000. Let that sink in for a second. All right, here's what you actually do. 5 things. Number 1, check your work benefits this week. Ask HR 3 questions. Do we have long-term disability? Is it own occupation or any occupation? And who pays the premium? Because that decides if your benefits get taxed. Number 2, do the 60% math. Take your gross income, multiply it by 0.6. Could your household survive on that? If your work plan only covers short-term, you've got a gap. Number 3, if you have a gap, get quotes on your own policy. Budget 1 to 3% of your salary. Yes, it's real money. It's also 1 to 3% protecting the other 97%. Number 4, pay with after-tax dollars if you can. Tax-free benefits beat a small deduction today. And number 5, build your emergency fund to cover the waiting period. 90 days minimum that lets you pick a longer wait and cut your premium. Do those 5 things and you're ahead of 51 million adults rolling the dice right now. Quick but important. This is general educational information, not financial advice. Insurance is regulated, policies vary a ton, and your situation is yours. Talk to a licensed agent or financial advisor before buying anything. If this video saved you from a $500,000 mistake, the subscribe button is right there. We translate the fine print so you don't get screwed. New videos every Monday, Wednesday, and Friday. I'm the Insur Nerd. Go check those benefits.